Question 3 says, refer to the information contained under the following heading, the Biggles Trust. So this is also under Part B still. For each of the transactions or events listed, calculate the tax implications for the current year of assessment and clearly indicate with explanation the taxpayer who would include these amounts in the calculation of their taxable income. Okay, so it's the Biggles Trust over here. So let's just quickly remind ourselves here. So the Biggles Trust is a trust that was created in terms of the last will and testament of Nathan Biggles. So what you need to understand here, this is a testamentary trust. So there's no donor in this case that we can identify. So Section 7 is the one that we consider when we want to tax the donor instead of the person who actually received money. So for example, Section 7.3, the donation to, if it's a donation to a minor child, are one of the ones that we can think of. But Section 7 is not applicable, so we can only apply Section 25B. Section 25B says that the person who has a vested right must be taxed on it, and if no one has a vested right, which is the case here, if it's not paid out of the trust, so if the trust holds it, the trust must be taxed, but if it's paid out to beneficiary, that beneficiary must be taxed. Then I just want to remind you that they say that they are trading in shares. They've got short-term shares that they have for trading, so that's stock. If you have shares held as trading stock, you should consider Section 9, capital C, which says if it's held for longer than 3 years, it must be treated as capital in nature. And then they also have investments, which are just capital in nature. The first one here is one that we saw it's from this trading portfolio. They sold it for 250,000, and 320,000 rands was the original cost, and it goes to Sally. So the first thing I want you to understand is that although Sally is 15 years old and she's a minor, Section 7 does not apply like we just discussed. Section 25B does. So Section 25B says that Sally will be taxed on the amounts. Okay, so that's just one of the first thing I want you to get out of the way. Then I want you to see here, so let's do it like this. Here's Sally, and here's the trust. Okay, so the sales goes into for Sally. The cost of sales, right, and the cost of sales in this case is just opening stock. That's what we had. The cost of sales is a bit of a problem, so let me show you. So if you did that 320,000, it means that she is going to have a 70,000 rands loss, Sally. If you go and look at Section 25B, and we're talking here about 326, they give you the rules about what happens to these types of deductions. And they tell us that she can't have this loss. So what they say is this deduction for her must be limited to 250,000. Let me actually show it in a different way. I think this is going to be clearer. Okay, so she's not allowed to get that. So we need to add back 70,000 rands so that hers is null. And that 70,000 rands deduction is then a deduction for the trust. So the trust can claim that against its other income. Now there's another rule that says if the trust has income, let's say of 60,000, and then that's a loss of 10,000, that 10,000 must be taken to Sally again, but only in the next year. But it's obviously not as common to see. So that's basically what will happen in this case. So understand that her total deductions are actually 320 minus 70, so 250. So she will have a deduction of 250, and she'll also have income of 250. And the trust will just have deduction of 70. Right, and then we have the Galumpi, number 2. Now in Galumpi, the situation here is we are just receiving money. We received a distribution of 80,000 rands in our bank account. 80,000 rands has 30,000 rands in it of contributed tax capital. Contributed tax capital is not subject to dividends tax. So the remaining 50,000 rands was subject to dividends tax. So what I want you to see is, so 50,000 times 100 over 80 gives us the amount before dividends tax. Okay, because 62,500 minus 20% gives us 50,000 rands. You can check that on your calculator. The 12.5 is the 20%. Okay, so, and I say this was retained in the trust, so the trust will be taxed on this. Okay, so all I want you to see, this is what's going to happen to the trust. Here's the trust. It's going to say it has received a dividend of 62,500. The full amount was exempt under section 10(1)(k). Now, these shares are being held as capital. They form part of our investment portfolio. So we're going to apply paragraph 76B. I just want to quickly remind you, if this was not investment portfolio, if this was the trading portfolio, then that 30,000 rands contributed tax capital would be added, because then it's an amount received in the scheme of profit making. Right, but that's not the case here. So, that return of capital, remember what happens to return of capital. You take the base cost of the shares, and they tell us the base cost of the shares here, 400,000 rands. And from that, you deduct the contributed tax capital. That's what paragraph 76B tells us. So that's 30,000. So that gives us 370,000 rands, which is a new base cost. Now, my spacing is a little bit out here, but let me just quickly explain to you, or show you. If this is our CGT column, and this is our rands column, so the dividend and the section 10(1)(k), the amounts we had at 62,500, they were there. This calculation here, this 370, does not go here or here at this point in time. It's just a calculation that you need to show. If next year we sell it, you will use 370,000 rands as the base cost instead of 400,000. Or when we sell this asset, it doesn't have to be next year, it could be later even this year. Okay, so guys, if I just take you down, here are the discussions. Sorry, over here are the discussions. You'll see I've indicated some half marks and so forth, just what I would suggest there. There are some extra marks available. Please make sure that you look through it and work through it if you've not yet done so. And that's it. Thank you very much.